All right, Mix 1041, MixTV.tv. Right now, we're joined by our friends from Alon Planning Partners. We have Jay and Brittany Hagee here in the studio. Great to see you both, as always.
Hey, Bridget. Great to be here. How are you doing?
Doing well. Okay, so today we're going to talk about how we're positioned in our investments and why it matters even more as you're nearing or in retirement.
Yeah, and so we talk about allocation a lot. We talk about how you're positioned. And, you know, with the market volatility we've been feeling the last few months, people understand it's important to look at how you're positioned in the markets. But when you're near or in retirement, that 5-year window, maybe before or right after retirement, it depends. It depends on what you're looking at, but it becomes the most important part of retirement planning when it comes to income planning. So a lot of times you look at average return. So you're looking at the 10, 20, 30-year return of like the stock market and saying, hey, we've averaged 10% a year, 12% a year. Well, that's great. But in retirement, sequence of returns matter more than average return. And I know we're getting in the weeds here a little bit, but average return is not the king anymore. It's how you get those returns year to year, because now you are living off of this money. You've saved your whole life. You want to be able to use it. So I kind of have an analogy that I tell people about like this, and it's, think that you have a big bucket of collected rainwater that you've got to survive off. You've been collecting rainwater for years, right? And you've got this huge bucket of rainwater, and you know that you're going to have to scoop out a cup a day to be able to live on, right? And so say that when you go into retirement, you've been used to it raining every day, but now it happens to be a drought. And so you're taking the cup out every day, and there's no more rain coming in, and it's evaporating over time. That's kind of what our allocation structures do and our funds do if we go into retirement in a bear market or the markets are down. The markets are going down. So we have to prepare to not take a lot of loss, because losses hurt you more than gains help you. And so we want to make sure that that bucket of rainwater is replenished. So if it continues to rain early in your retirement, you won't have to worry about it. You just keep drinking the water. But if it doesn't and there's a drought, you better conserve as much as you can.
So it's not just about this average return. Everybody, like he said, gets kind of hung up on that. Well, what's my average return? Average return doesn't matter as much as you're entering retirement, because if you were to take bigger losses up front, you have way less to work with as you're taking distributions from those accounts over time. So that matters more than just, hey, what's my average return over 10 years? That's going to hurt you if that's what you're looking at. We actually had a couple come in. We met with them this week that came to us in this situation. They were taking distributions from their accounts, and they were positioned in ways that were really, really high risk. So recently, you know what that equates to, right? Down in their investment accounts, so a decrease in their investment accounts. So the investment accounts are down, and they're also taking these consistent distributions from their accounts.
They were quite large, yeah.
Yes, and large distributions for the percentage of their overall investments. And so we had to walk them through, hey, here's why your positioning matters. If you continue on this path with your current positioning, current distributions that you need to live on, you will run out of money, right? That's why this matters. That's the whole point right there, to help folks not run out of money. So it stems back to the root of positioning, how your position matters. So thankfully, we were able to help this family reposition some of their assets to where we took some of the risk off the table so that they could continue taking the distributions they need, have some, continued income to support their lifestyle, but not be riding the roller coaster of ups and downs to where they're losing too much, potentially, like right now, losing too much in the market accounts up front as they're entering retirement. So that's a practical example of really what we do and how we help folks to ensure that their number one fear does not come true, running out of money, right? I don't want to run out. And listen, this even applies to folks who have significant nest eggs.
Right.
We have another client who has, I won't get into the details of it, multi-millions within their account. And they are so stressed about running out of money.
Right.
And we have helped craft a plan to say, hey, here are the steps. You can't run out of money following these steps, right? And that has brought such peace of mind to them. So it's not just for those who have, smaller accounts, maybe you say 250 or 500,000 and you're like, how do I make this work? Okay, that's one thing. But another piece is for those who have multi-millions in their savings and investments. They still feel the same way. It's the same core concern, no matter where they are. So we help folks in all walks of life navigate
we just
that.
wanted to raise the red flag this morning because we have been seeing clients that have had really great strategies when it comes to their investments, but they haven't
grown
had
well.
an income plan.
Yeah,
And
right.
so income planning in retirement is how you ensure you don't run out of money. And so one of these areas of sequence of return risk versus average return is important for you to know. So if you're listening today and you may have done really well in your investments and you may be feeling okay about how that's going, but you're close to retirement or you're in retirement taking distributions already, and you're a little unsure whether you're going to run out of money or not, that's why you want to come sit down with us. And we offer a complimentary consultation for anyone that would like to.
Yeah, and you can reach out to us directly through our website, allonplanning.com. That's ALLON planning.com. Or you can call us directly, 423-315-1441. You can schedule that complimentary consultation from our website or again by phone to meet with one of our independent fiduciary advisors to help you really craft a comprehensive plan to get you not just to retirement, but through retirement.
That's Allon Planning Partners. Again, that number 423-315-1441. Online at allonplanning.com. They'd love to sit down, talk with you, and help make a plan with you today. That is Jay and Brittany Hagee. Thank you all so much. Great to see you.
Thank you for having us.
Thanks, Bridget. You too.
Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.